Welcome back, investors, to Ticker Time News. I'm Adam. And is it time to go long, or is there more falling to come this week? Well, there's only one more day left in this week. That question and more will be answered in today's live stream. Plus, the most important part of this live stream, your questions will be answered too. Now, it was a trend down day for the stock market amid growing recession concerns. On the heels of the FOMC rate hike decision yesterday, market participants received a slate of generally disappointing economic data today that amplified the market's recession concerns. The main concern for market participants is that the Fed may over-tighten, and if they do, trigger a deeper economic setback in the U.S. That thinking stoked a belief that 2023 earnings estimates are too high. So today's trade reflected a general buyer strike as investors rein in their willingness to pay a premium for earnings that are likely to be subject to downward revisions. The slowdown isn't just an issue confined to the US either. Other central banks around the world have been raising rates all year and have pointed to the likelihood of more rate hikes to come, all to get inflation under control. Yesterday, or since yesterday's close, the ECB, the Bank of England, Swiss National Bank, and the Hong Kong Monetary Authority all raised their benchmark rates by 50 basis points. Now, today's economic reports, they only added fuel to the recession concerns. China's November retail sales, industrial production, and fixed asset investment data were all weaker than expected. Now, the November retail sales here in the U.S. and the industrial production also for the U.S. were, well, pretty bad, as well as the December Philadelphia Fed Index and New York Empire State Manufacturing Survey. Again, weaker than expected. Specifically, for the November retail sales report here in the U.S., it dropped to negative 0.6%. Expectation was a negative 0.1%. Now, this is big because last month it was a positive 1.3%. That's a big slowdown and shows that monthly sales declines were logged in nearly every discretionary category. A couple exceptions were miscellaneous store retailers. Think about those off-brand type stores. They were actually up 0.5%. And food services and drinking places were up nearly 1% at 0.9%. And just as a side note here, as the economy weakens, alcohol sales do tend to go up, so that kind of makes sense. And then for the November industrial production report, there was broad-based weakness in the manufacturing sector. The indexes for durable and non-durable manufacturing were both down 0.6%, while the index for other manufacturing dropped 0.4%. Now, due to the weakness in all of these reports, the broad-based retreat brought the S&P 500 below 3,900, which has been a level of support for several sessions. And going back over a month, that has been a very sticky level, support and then resistance sometimes. Yep, just a little bit early tonight. My apologies for that. Got done a little bit sooner than expected, so I went live. I should probably, and actually this is a great question, and I don't know if I can do a poll in the chat. I don't know if I can do that. I'll figure out if I can. I want to survey everyone who watches and pick a time. Let's pick a time. I think it's way beyond time to do that, quite frankly. Pick a time that works for the majority, right? Is it 7:30 all Eastern times here? Is it 7:45? Is it 7 o'clock? What time makes sense that we can start consistently at the exact same time every single day? So I'll see if I can't get a poll in the chat, not this live stream, but maybe on Monday's live stream, and get a poll in the chat so you guys can weigh in on that. Now, I know in the community section of our YouTube channel, I can post a poll there. So I will post a poll on our community page on our YouTube channel at Ticker Time News, and I will see if I can't get a poll in the live chat for Monday to see what time works best so we can start at that same time every day. I think that would actually help out, quite frankly, for all of us. Okay, so S&P 500 down below 3,900. It closed at 3,895. But get this, it reached 4,100 just on Tuesday. Just a couple of days ago, the S&P 500 was at 4,100. With this drop, I did close my short position on the S&P 500, ticker SPX, late this afternoon. And I also started a small long position on the QQQ as the 275 level seemed to start building as support. And I know that around the 270 level, there will be some support there that steps in. So if the QQQ moves lower, I will just add to this position and maybe get it up to a full size long position on the Qs. Plus, as we look through the Qs later on when we dive into the charts, the Qs are down over 7% in the last 3 sessions. And the possibility of a bounce, even a small one, is growing, in my opinion. So we'll see if we can't just put that together and get that to work out. The S&P 500 over that same 3-day session from its peak to trough was down 5.43%. So those are big drops in a short period of time. So the likelihood of bounces just seems to be growing. The risk reward for a bounce seems to be growing. Now, I'm not saying that we're going to be green tomorrow and everything's going to be fine. We could have another big down day tomorrow. It is all in the realm of possibilities. But when we dive into the charts, we'll look for these support resistance areas because there was a very couple specific points that were broken that has held as support and have been a major area of stickiness, as I like to say, when it's resistance and support back and forth. So we'll get into that when we get into the charts here. Let's see here. It's amazing how all the bears come out at once with the bear market rallies. Isn't it, though? It is interesting. When the market is at the peak, right? Bulls are, yep, this is it. We're going higher. Who cares about prior resistance and holding the market back? We're going to break it. We're going to go above it. And then once we drop, the bears come out. Yep, this is it. It's over. We're going down for good this time. Yeah, right. But we'll get into that when we get into the charts for sure. It is interesting. It is amazing, isn't it? Okay, mega cap stocks. They dragged down index level performance today too. The Vanguard Mega Cap Growth ETF, ticker symbol MGK, it was down 3.3% versus a 2.5% loss in the S&P 500. Now, growth stocks in general fared worse than value stocks. The Russell 3000 Growth Index was down 3%, while the Russell 3000 Value Index was down only 2.1%. Now, the Treasury market didn't do much today. The 2-year yield fell only 1 basis point to close out at 4.25%, and the 10-year yield fell 5 basis points to 3.45%. But that good old U.S. dollar index, it jumped 0.8% to close at 104.64, which took I should say, which took its directional, oh, I lost my train of thought. The U.S. dollar, that's what we were talking about. It rallied up to the top of its falling wedge pattern, and it actually tagged that downsloping resistance line and pulled back slightly. Actually, let's start there real quick on the charts, and then we'll go through the list of charts that we normally talk about. The U.S. dollar index right here. Let me pull this up a little bit so you can see better. The US dollar still within its weekly expected move, which was a pretty big spread this week, all the way down to 102.8 on the bottom end, on the top end, 107.03. But you can see today's move, it was a pretty nice move for the dollar, tagging perfectly that resistance. And let me get my Sharpie out, make things a little easier. So that down sloping resistance that I'm talking about, that red line right there, it came up, the wick tagged it, it pulled back a little bit at the close as markets started to find their footing and kind of turn the corner just a little tiny bit at the end of today. But the dollar still, it's right there within that falling wedge pattern. And I want to show you something else, okay? On the US dollar, let me adjust the chart real quick, and I'm going to go to the weekly view, okay? Weekly view for the dollar. And there's something very, very interesting. Let me draw this together here a little bit. Okay. Weekly view for the US dollar index. Ticker is DXY. I want to point something out real quick. Let me move these two Sharpie marks here. And one more. Okay, look at this. Look at this. For the dollar, here, right here, resistance. For the dollar, right here, resistance. For the dollar, the lower end of the weekly expected move lines up nearly perfectly with those two prior instances of resistance on the US dollar. It broke that earlier this year in May, maybe as early as like the last couple days of April. But now, what's the dollar doing? The dollar is pulling back sharply, as it has been. But as I open this up here, leaving that highlighter mark on the lower end of the weekly expected move, again, this is a weekly chart, so the candles are going to look a little bit different than on that daily view that I showed you when we were zoomed in. Okay, now let me remove that Sharpie so you can see it a little clearer. But this is going to be an extreme test for the dollar. Can it hold this prior resistance area as support? If it does, that spells bad news for equities, okay? But if the dollar were to break this prior resistance area, and it's right around 102.5, okay, that would be really negative for the dollar, but positive for equities. So keep this weekly chart here refreshing and watch it, because if that dollar breaks below 102.5, then it didn't hold as support, and we could see further downside for the dollar. This is very important to watch. I can't stress it enough. Ticker DXY. And 102.5, put a marker there and watch on the weekly time frame to see if the dollar can hold it. Now, this week, the dollar got down to 103.4 as its lowest mark. And that was the lowest mark the dollar has seen going all the way back to June of this year. So several months ago. Will it hold this ultimate area, 102.5, or will it break it? That's the question, right? So right here, I'm going to put a little text reminder, 102.5. Okay. We need to watch the dollar and see if it can hold that. And I want to put it right over here at the beginning of January. Okay. So that way we can run into it. It's right on Monday, January the 2nd. which will be obviously the first trading week of 2023. So will the dollar continue its decline? Will it get to 203? Will it magically, I don't know, bounce from there or sink? Let me do one more thing. I'm going to put a horizontal line here as well at 102.5. And I want to change the color of this so we don't get it confused with the weekly expected moves. I'll go blue since it was support. So you can see the weekly expected move is just slightly below, slightly above where that 102.5 level is on the chart. So on the weekly time frame, watch that. All right, let me go back to the dollar, and then when we have it on the daily time period here on the chart, you can see that it's looking like it's going to march right down there. And is it going to tag it and that be the ultimate? And then we just drag this support line down here, keeping it lined up. And I want to get to that 102.5 area. If the blue trend line in this falling wedge, if that support line holds and the dollar does go down to 102.5, it looks like the day of reckoning is Tuesday, the 20th of December. Tuesday, the 20th of December. That'll be a critical day if the dollar hasn't bounced and moved higher by the time we get to that point, because that's where that bottom support line in the falling wedge lines up with the 102.5. Let's see here. LOL. Everyone on CNBC went from Uber bull to Uber bear, calling for a horrible recession. Yeah, we're going to get a recession in 2023. I'm firmly in that camp that we will see a recession in 2023. I don't know the time frame when that may occur. Since the historical marker has been 2 quarters of negative GDP plus unemployment rate that has risen at least substantially, getting into the 4, maybe 5%. With that criteria, maybe the middle of 2023 could be the start of that recession. But remember, it's always lagging because we have to go through 2 quarters of GDP at negative growth. And of course, we got that at the beginning of 2022. Quarter 1 and quarter 2 were both negative. However, the employment situation was pretty healthy. So we couldn't really call it a recession, although it was a technical paper recession that we had. Okay, continuing to move on. Let's start at the top, go to SPX for the S&P 500. Like I said earlier, about 5.5% is how far the S&P 500 has fallen in just the last 3 sessions. Now, the important areas to watch here, number one, if we're looking at the chart here, notice the volume shelf profile on the left side of the screen, okay, where you have the red and green bars sticking out from the left side. The biggest point of trading happening, right, buying and selling, is right around the 3960 area, okay? There's a red line that goes across the screen right here, and it really cuts this chop right in half right there. And if you look at today's candle, we opened up below. We gapped down and opened up below that 3960 area or the 3955 area, which has been very sticky over the past month and a half now. So breaking below that was significant, but not a major concern because we've done it before multiple times over the past month and a half. But the important line, very important line, is 3,900. As you can see, bottom right corner of your screen, we closed at 38.95. So we got down below 3,900, which has been a very sticky area. The last time we got down to 3,900 even would be right here on November the 17th. And you can see here, it acted as resistance. Back here, it was resistance. So that 3,900 level has been very important, and we closed below it. Now, since we closed below it, does that mean that we could possibly see a bounce? We're just barely below it. Could we potentially see a bounce from that? Well, when we look at the RSI, Relative Strength Index, we're basically at a 50. It's a 49.9. That means that there is strength in the trend we are in, and that trend right now is down. So there is some strength there. The MACD shows, well, nothing is in territory of crossing, right? Nothing is signaling that this trend could be over. We would need to see down here on the MACD, we would need to see that blue line curl up. But today, because of the past 3 sessions, it's curled down. So really, nothing looks bullish here. It looks bearish. This MACD line, it needs to be pointing in upward fashion, crossing the red line, crossing back above the red line to show that the trend is changing. And again, with the RSI going all the way back to December 8th, it's basically been moving sideways, holding right around 50, which is right in the middle, right smack dab in the middle. 30 and below is oversold. 70 and above is overbought. So we're nowhere near those levels, so we could continue going down. Now, I'm going to change this up. Let me clean up the chart here. I want to go to the 5-minute view for the SPX. Let me fix the chart right quick. Okay. 5-minute chart. This is what we got here. Oh, and there's one more thing I want to point out too on the daily. Okay. All right. I have the past 2 days on here. All right. Yesterday's volatility in the afternoon, major volatility. I mean, look at this. Just boom, 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 boom. All the way around, all afternoon, big volatility. Now, there is, I know it's hard to see. It's hard to see on the small screen here, but there's a dotted line, and it is right here. Okay. That is the upper end of the quarterly expected move. Just like we have the weekly expected move that comes out every Sunday evening. I publish it to our private investor community. If you want to join that, by the way, just click the first link in the description. We have the quarterly. We can also get a monthly expected move. And that quarterly expected move on the upper end was tagged yesterday. All right. When the market went up, it tagged it right here. And earlier in the morning, it actually used the quarterly expected move as resistance. It went right up to it, stopped, moved sideways for about an hour or so before coming back down. Now, that quarterly expected move on the upper end is at 40.50. 40.50 is the quarterly expected move on the upside. Now, on the downside, it is way, 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 way down there. I'm not sure we're going to come anywhere close to that, but I did want to point that out. Okay, don't want to miss your comments as we're going through this. Let's see, $858 billion defense bill. Which stock benefits most? Your main players. Lockheed Martin, that's a big one. Oh, you caught me off guard here with this one. Boeing could be in on that. Holy moly, I'm drawing a blank literally on the main defense contractors. There's even some smaller ones out there. Holy moly. Oh my goodness. I am drawing a blank, but I'm going to write this down so I can get back to you on that. What I'll do is I will post it in our public Discord channel, defense contractors, and I'll get it up there either tonight or tomorrow. And you see, I'm writing it down right here, so I won't forget. I always, this notebook right here, it is full with all kinds of ideas and stuff. And it's over here. I'm left-handed, by the way. But as I'm charting, as I'm researching, I'm constantly just jotting notes down while I do it. So, defense names. All right, I'll post that in a couple of places. I'll post it on our public Discord channel. I will tweet out a few of the names that will benefit from defense, and I will also post it on our public, I forget the name of it right now, our public channel on our community tab. That's what it's called. I'll post it on our community tab on our YouTube channel, so that way there's 3 different places you can find it. Everything is at Ticker Time News. So I'll make sure to get those names out there to you either later tonight or tomorrow. And a lot of them have gone up significantly this year, are indefinitely, steadily in the green because of what's happening in Ukraine. So that is just, oh, Raytheon, yep, that is one of them. Okay, good question here. I'm assuming that this question is also in reference to your. Okay. Stop. Stop. Hey, Google. Stop. I haven't had that happen before on a live stream, but she just started talking. Okay. Back to your question, how this adds up to Fed balance sheet. So what the government does and what the Fed does, slightly different, okay? The Fed's balance sheet, when we were in unlimited QE, which was, or quantitative easing, which was announced in 2020 from the pandemic, which they go through rounds of QE or quantitative easing whenever there's trouble in the market, and it helps to prop the market up. Usually, they set an amount of money that they will use for quantitative easing. But when the pandemic hit back in early 2020, they announced unlimited QE. So they would pump as much money into the market as necessary to keep the market elevated. And for the first time in my lifetime, 2020 showed that the stock market and the economy are not exclusive and linked together. They are 2 different machines that work separate and independent of each other. Because in 2020, when the economy was shut down, what did the stock market do? It went to all-time highs. That shouldn't have happened. That shouldn't have happened. But instead, the Fed, with unlimited quantitative easing, which is basically just putting money into the market. putting liquidity into the market. There is a direct correlation to the Fed putting money into the market and the market going up, just as there is a direct correlation to the Fed in their current QT, quantitative tightening, taking money out of the market and the market going down. As a matter of fact, I think I can show that here on the screen. But let me get real quickly, just finish my thought here on the 5-minute chart, and then I'll go back to the daily and show you the correlation. Okay, just wrote that down so I wouldn't forget to. All right, so let me clean this up here right quick. Okay, this morning, gap down right here, all right? Big gap down. Now, I had a short position that I opened about around this level right here yesterday. Once the summary of economic projections came out and I was able to skim it, and I saw that the rate, the terminal rate or the nominal rate or how high the Fed is going to raise rates jumped by 0.5%, that's when I was sure it was going to scare the market, and it did. So I took a short position right here yesterday, and then today I closed it out late this afternoon, somewhere around when the market was trying to find a rebound, trying to find a place where it could go and maybe gain back some of the losses. Because you see right here, there was pretty steady support right there, okay? And that happened to come in right about 38.80, where it found its footing, and it was able to turn it around, and it tried to rebound, but every time it did, it just was met with selling pressure, and it drove it right down quickly. Let me show you here. Let me go in here a little tighter, open this up, and then I got to get it out of the weeds real quick. For those that have been watching this channel for a while, isn't it so nice that TradingView is so smooth now and it's not so laggy like it was? I love it. Okay, this point right here. Now, what was that price point? That was right around 3,900. What do you say? 3,900 acted as resistance when this was trying to find its footing, which it did right here, and it tried to rally, but at 3,900, selling pressure came in. Now, earlier this morning, around 3,900, that acted as support. It acted as support to stop the market from falling, but it only lasted for so long, and now we're on the flip side of that. So that, like I said when we were looking at the daily view, that is a negative sign for the market. You add in the relative strength, you add in the MACD, you add in the other specific areas on the chart, and it all lines up to, wow, can we get a bounce, or are we really going to go down further, right? Well, one thing that is good about tomorrow is there's only one real piece of data that's coming out, and it is the IHS Market Manufacturing PMI and Services PMI. That comes out tomorrow, I believe, at around 9:45 Eastern. And that's really the only bit of data that comes out tomorrow. So with that being said, we know that for that piece of economic data, manufacturing slipped under 50 for the first time the last time this came out. Oh, and I should add that this is the preliminary report, so it's not the final report. 50 and below is contraction. And we saw that, like I mentioned at the beginning of this video, with the manufacturing data that came out today. Manufacturing is suffering right now. It is slowing down. It is contracting. And remember when we talk about the phases or market cycles, wait, is this the one I want? No. Where's the other one? Sector rotation. Yes, this one. This is what I wanted right here. When we look at periods of contraction and expansion, pretend like the black line that is going across the screen that I'm drawing and highlighting in red here. This is 50, the number 50, okay? And anything above that, we are expanding. The economy is growing. Anything below that line, right, that would be 50 and below, we are contracting. The economy is contracting. And with marketing and services, or I should say manufacturing and services contracting, that's a good indicator that we are finally crossing out of stage 6, excuse me, and crossing into stage 1 of the cycle, okay? And just while we're here, let me just reiterate and point out again that when we are crossing into stage 1 of the cycle, what works? Bonds do. Bonds go up while stocks and commodities go down. So we are still in the potential for the market to fall further. Now, of course, the market doesn't go down in a straight line, so there will be rallies. They won't be huge by relative terms, but the market doesn't go straight down. So with manufacturing and services below that 50 line or 50 number, they are contracting. So we are shifting over to stage 1. We're someplace in a gray area, I think, right now between stage 6, the final stage of the cycle, and we are transferring over to stage 1, the first stage of the cycle. And you can see here, when we get to stage 1, we are contracting and we're going down. We don't reach bottom until the recession, until stage 2 kicks in. And by that time we reach stage 2, that's when stocks and bonds are going up and commodities are what is still going down. Okay, I didn't plan to talk about this, but I think it made sense for the conversation that we're having right now to bring this chart up and just to reiterate where we are, where we're headed, and what works. Now, if you're looking for a bond, a ticker to potentially get into, TLT is the ticker, and that is long-term treasuries, okay? As a matter of fact, I can pull that up and show you how it's been pretty hot recently, and it's just going to continue to improve. Okay, so that's a couple of things I wanted to point out there. The market finding its footing. The market had support at 3,900, getting rejected at 3,900 later in the day. What's tomorrow going to bring, right? Well, I think there is a growing risk-reward situation for going long or starting to look for long positions right now. The market's not oversold yet. Today, in the Qs, I did open up a small long position. I'm so used to saying short this entire year. It felt weird to say that. Okay, let's go back to the daily view here for the S&P 500. Let me adjust the chart right quick. Okay. The one other thing I wanted to show you here on SPX, and then we'll be quick on the SPY because it's basically the same, just different numbers, is our top in our bottom in the market over the past 3 sessions. A lot of volatility this week, and that was to be expected. We knew that we were going to get that volatility because CPI and FOMC. But the top, right, the very top, see this black line? I'm highlighting in it blue. And actually, let me move this out of the way. And then this black line I'm highlighting in blue. Well, guess what? The top in the market 2 days ago or 2 sessions ago, it almost tagged that top black line. Today, the low of today, where the market found support, almost tagged that bottom black line. Now, what are those 2 lines? Well, both of them are anchored VWAP lines. The top line is tagged to the very top of the market. It was either January 3rd or 4th of this year. And the bottom line is tagged to the absolute low this year, which was on the 13th of October. I find it very interesting that we didn't get above that and we didn't break below it. We were squeezed right in between those 2 lines. So when I say I'm looking for potentially setting up for a bounce, whether it happens tomorrow or maybe next week, this is one of the driving reasons. Because we couldn't break above it when we were up top, neither on December 1st when we got close to it, and we couldn't break below it today either. Now, that doesn't mean that maybe tomorrow it's a red day. That's always a possibility, okay? And let me just give you, we close up here. There's nothing that says that we don't go down tomorrow and then close right on that anchored VWAP for the low of the year. That's a possibility. But this is why I'm looking for potential long positions. And it's why I started a small one in the Qs today or this afternoon. All right, let me clean this up here right quick. Get that marker off here. There we go. Okay. Let me refresh this chart right here and bring in 2022. Okay. Let me see if I can add what is this one? No. Okay. No, that's the Fed funds rate. That's not what I want. Draining reserve balances. No. There's some way that I can add the balance sheet on top of this. I know it's here. I'm just not sure exactly which one it is off the top of my head. This one's it. This is it. This is it. This is it. Okay. if I go back in time, let's just put the peak of 2022 up here. The orange line is the Fed's balance sheet, okay? So as that orange line is going up, the Fed is putting liquidity into the market. As that orange line is going down, the Fed is taking liquidity out of the market. And you can see that there's a direct correlation to the markets going up when QE is in effect, quantitative easing, and the Fed is putting money into the market by buying all kinds of things, mortgage-backed securities, all kinds of things. But basically putting liquidity in the market by buying assets. Then when it reaches the top and it starts to roll over, well, the market was really shaky when that occurred. And of course, some of this over shakiness occurred right as the lead up to Russia invading Ukraine. So it was a little overdone because of that, and not directly because of the Fed taking money off their balance sheet. But now, as the Fed is taking liquidity out of the market and that line is going down, what is the stock market doing? It's also going down because liquidity is being taken out of the market. Okay, just a real simple concept to understand there. Okay, quantitative easing is when the Fed puts liquidity into the market, it buys assets. Quantitative tightening is when the Fed is selling those assets and taking, wait a second, did I say that wrong? Quantitative easing, QE, is when the Fed is putting money into the market, putting liquidity into the market and buying assets. Quantitative tightening, which we are in right now at the tune of $95 billion a month of liquidity being taken out of the market because the Fed is selling the assets on its balance sheet, okay? Now, there is a gray area in between there when stuff is being put on and taken off of their balance sheet. So it's not a direct, clear view of, at least for me at this moment in time, of what's being taken off and what's being added at any given time. Not something that I've studied or looked into too much, to be honest with you. I'm just understanding this very simple premise right here of what the Fed is doing with exactly what you just said right there. It is scary how crazy money printed. Yeah, it is scary. The Fed printed money to prop up the stock market and have it go to all-time highs during a time in which our economy was shut down or extremely limited. And that's why I said earlier that for 2020, that was a eye-opening experiment for me. That shows the economy and the stock market are two different things, and they do not have to work in unison. They can be lopsided and move all around, and it's all a manipulation. The Fed has that much power. All right. So, yes, very interesting. And my apologies. I missed it. Can't believe it gave up 3,900, 390. So easy. Yes, it did. Back when we were talking about that 3,900 level, which would be 390 for the SPY. Okay, let me take this now off like so. And I'm going to go to the SPY and then the DIA. And then the and then the, wait, I'm going to go SPY Qs, DIA, and IWM. Okay, let me get this lined back up. as we go to the SPY. And give me a quick second to get this opened up. And basically for the SPY, it's the same thing as what we were just looking at with the ticker SPX. Both of them track the S&P 500. It's just that the SPX, there is a lot more volume and a lot more money that goes through that ticker over the SPY, okay? All right, so we still have the anchored VWAPs for the high of 2022 and the low of 2022. And the SPY didn't get quite as close to the low today. And it did break through 390. It closed at 389, 1 point below it. So, hey, in my eyes, I think we're close to a potential bounce right here, just due to the fact that the market has sold off for 3 straight sessions in a row and with pretty big moves. I mean, today, the SPY down 2.45. Yesterday, not much. It was down 0.6. The day before, it was down, or my apologies, it was actually 0.7. But it went way up there and then got pulled way back down. Remember, at the open with CPI, it had jumped sky high. Okay, so those marks are important. 390 is critical for the SPY. If it wants to catch a bid, it's got to be able to get back above 390 for there to be any hope in it continuing to catch a bounce. Now, as far as the anchored VWAP down here, there's also the 50-day moving average that is just below it at 385. And 385 has been a sticky number for the SPY as well. So if it gets down to 385 and we're at 389 right now, I could see a potential bounce in the SPY. Not saying it's guaranteed to happen. I don't have that crystal ball, and sometimes I get things wrong. But I think as far as where's an area to start looking here after pulling back like this over the past 3 days, that, yeah, that could be an area to pay close attention to. But we also have to remember that 380 is where the lower weekly expected move is. So it's not out of the realm of possibility that the SPY just completely skips over that anchor VWAP and the 50-day moving average to drop down to the weekly expected move. It is possible, but I do think that anchored VWAP and 50-day moving average will be an area that it has to contend with. Market participants have to decide, well, is this an area for us to hold, for us to digest all the data that we got this week, and then move from there next week? That is a possibility because the market moves in cycles, right? Expansion and contraction, two of the easiest ways to picture how the market moves. And with that expansion and contraction, let me just demonstrate. Down here, when we bounced off this line here, right? We expanded and then we contracted, all right? And I can even back it up and go even tighter with that. We contracted, right? We expanded, and I would say that would be an expansion too. Then we contracted. Now we have expanded and expanded. Now we need a time to contract. The market moves like that. Expansion leads to contraction, which leads to expansion. So just keep that principle as a principle for how the stock market moves, okay? And whenever we have big data weeks, right? When we have a lot of data coming at us, the market will move fast, okay? But the market hasn't truly digested that data until it starts to contract. That's when it digests all of the data that it received. So all the data that we got this week, the market has not yet started to contract and digest that information. Read the details of those reports instead of just emotionally responding to those reports, right? Or I guess I should rephrase that. Instead of emotionally reacting to all of that data in those reports, to the market digesting and making a decision, not a reaction, but a decision based on all of that data. Okay, let's go on here now. We're going to go to the Qs next. All right, for the Qs, the weekly expected moves, let me just point those out. On the top end, we've got 293. On the lower end, 270, okay, for the Qs. Now, when we look at the volume shelf profile over here, the biggest price point that gets the most volume is right here at 280, and it runs right through here. It has been a real big support area in this chop box that we've been going through for over a month now, okay? And over the past 3 sessions, from the very, very top to the very, very bottom today, the SPY has moved 7.14%. That's a big move, and it's got to be digested, right? The market's got to digest this information and this big move. So let me do this real quick because I do not have, and I don't know why, I don't have those anchored VWAPs. So let me add them real quick, okay? I need to add it to the low of, oh, that's interesting there. The low for 2022 and also the high for 2022, which looks to be, what would this be? It would be January the 3rd, the closing day of January the 3rd. So I need to go here, January the 3rd, and place that anchored VWAP there. Okay, now let's go back over here and open this up and expand it. And oh man, just looking at this, you can see there is a structural difference between the S&P 500 and the NASDAQ composite. The SPY and the Qs are not structured the same. The Qs have gotten completely beaten up this year. Just completely beaten up. And it today, it closed underneath its anchored VWAP. And that anchored VWAP, let me zoom in here real close. It looks like it's at about 177, 178. So we're about $1 or $2 or a point or two below that level there. Interesting. So for me, the support area here for the Qs, I think is probably 275, where we could potentially see maybe a bounce or a little turnaround. And with the weekly expected move being at 270, that is still in the realm of possibility that we could drop down there. But again, that would be another really big move day after day after day for the Qs to do that. But we've seen it before. You know, it's not out of the realm of possibilities. I just think that the likelihood of seeing some sort of a bounce after these big moves, or at the very least, a small one move sideways maybe, is more likely to happen. All right, let's quickly look at the DIA and the IWM, and then we'll wrap it up for tonight. Weekly expected move for the Dow Jones, or ticker DIA, 344 on the upper end, 326 on the lower end, and then the IWM. And then we'll wrap this up for tonight. Weekly expected move on the upper end, it's 185. On the lower end, it is 171. Okay. All right. Well, I'll wrap this up for tonight. I'll be back here tomorrow after the market has closed to talk about what happened, why it happened, what to expect going forward, and answer your questions. Because this live stream, seriously, the most important thing to me is answering your questions. And I greatly appreciate the conversation, the questions, and I will post what are the best defense type stocks to look at as we get into this crazy world that we're in. And again, a lot of them, when you look at them after I share them, and I'll post them again on our public Discord server. I will post them on our Twitter account and the community tab on our YouTube page or YouTube channel. All three are found at Ticker Time News. I'll post a handful of what I think are maybe like the top 5 defense type stocks that you should be looking at, and then you can take it from there and decide what's worthy of your investment or not. But again, a lot of them are up on the year due to Russia and Ukraine. Okay, one other thing, if you could please do me a favor, click that like button, and when the video is over, if you could leave a comment in the comment section and then share this video with a friend. Those 3 things, they take just a few moments of your time, but they really help out the channel, and they allow our message to get out there to a wider audience. And I would love to have more ideas coming in through our chat and more questions, just like the awesome ones that you guys ask every single live stream, which we do every day the market is open, after the market has closed. But that would be greatly appreciated, and I would love that. Okay, well, we'll wrap it up here. I want to thank you again for your time, for your attention, for being here with me. I greatly appreciate it, and I love your questions. I love to be there to answer your questions. So, yeah, you are welcome. Absolutely. And again, that long that I started on the Qs, it was a small position. And if the Qs do go down a little bit more, maybe get closer to that weekly expected move for the Qs, maybe I'll add a little bit more to that position and make it a full long position, because I do think that there could be a bounce here. Even if it's a small one, I'm expecting one to come in. So with that said, thank you guys so very much. I don't, this is the worst part of the video. I must admit, this is the worst part of the live stream, because I never want to go, because I want to make sure I'm getting your questions if you have one. And sometimes it's like, oh, the live stream's over, and it's like, oh yeah, I wanted to ask about that. So I try to give you as much time as possible, but I think I've done that mission today. So thank you guys so very much. It's an honor to be here for you. So with that said, I'll see you guys back here tomorrow after the market is closed. Oh, and like I said at the beginning of the video, I'm going to post a poll. I'll do it on our Twitter account, our community tab on our YouTube channel, asking you, what is the best time? What's the best start time? Okay. So that way we are starting on a set given time every single day the market is open. Make it much easier, I think, for all of us, you included, for that. So watch out for that survey. Yeah, okay. I guess that's it. Well, again, thank you. Have a wonderful evening, and I'll see you in the next video. Take care.